Good morning, everyone. We are going to continue with the statement of cash flows. To take a look first at our Apple investment, we know our phantom share stock was trading at $116.93 last Thursday. Today, it is trading hovering around that same price, $116.20. If you've been reading the financial news, which I'm sure you all have been, you know that the lack of a stimulus package has been affecting the stock market. Also, the fact that the coronavirus is spiking in certain areas again has caused instability in the marketplace. So things that you should be aware of, things you should be watching. So we'll move on from there. Please remember that this is an active learning semester. So in addition to everything that we review in class, I want you to also be aware of what's going on in the world, particularly on a financial basis. It's an election year. Okay, for those of you who can vote, you should vote and be active. Okay, be active in your learning. All right. So let's move ahead. One thing I wanted to mention is that we will be having a quiz on this chapter. Okay. We're going to have on chapter 13. I'm planning to have it on November 10th. Okay. So November 10th. The first half that hour of class is going to consist of a quiz on chapter 13. Okay, and then I'm anticipating that shortly thereafter, I have to look at the exact way that Thanksgiving, how it falls and when it falls, but I anticipate that as soon as we get back from our Thanksgiving break, I'll give you that opportunity to study. We will be having the second midterm. Okay, and then shortly after that, mid-December, you know that the semester will be over, and then we will be having our cumulative final. Okay, all of which are going to be on McGraw-Hill. Okay, so all exams will be on McGraw-Hill. Okay. All right, so let's move on. We know that we've been talking about the statement of cash flows, and that we know it's a very different financial statement. It is a required financial statement according to GAAP, okay, and that it has 3 sections, okay, and remember the 3 sections are the operating section, which is the most detailed section, which is the one where we've been working on. Then after that, we have the investing section. Okay, and then the third section of the statement of cash flows is the financing section. Okay, remember that in each of those sections, we are going to summarize what the sources and uses of cash were. Okay, over the past year. Okay, and remember that at the end, when we figure out what all the sources and uses of cash are within these 3 sections, that figure then, what we arrive at is going to be the change in cash over the year. Okay, and that change in cash that we generate here, that's going to tie into what the change in cash is in the cash account on the balance sheet. Okay, so you always know if you've done this, if you've prepared the statement of cash flows correctly, because you know that you're going to then tie into the balance sheet. Okay, all right. So we had been talking about. Let's move ahead. We had been talking about the operating section. Okay, and remember that the operating section, basically what we are doing. We are taking what the changes on the income statement are. So that's what you're focusing on in the operating section. You're starting with the income statement and you're unaccruing the balances on the income statement based on the changes that appear on the balance sheet. All right. Remember the information that you must have Okay, hint, hint, hint. When you're preparing a statement of cash flows, you must have the current year's income statement. Okay, in addition, you need 2 years' balance sheets. Okay, the previous year's and the current year's balance sheets. Okay, and then the third piece of information is going to be the additional information section. Okay, and what that additional information section, it's usually very important information. It helps you prepare the statement of cash flows. It supplements some of the things, because again, when you're looking at the income statement and the balance sheet, all you see are the ending balances in the account, right? Like you're seeing here what the net sales were, what the dividend revenue is, etc. You don't know what the journal entries are, right? That support what the transactions were that arrived at these balances. So that additional information section is very important, and typically it will guide you, okay, through your preparation of the statement of cash flows. Okay, now we know so far we were again in the operating section and we unaccrued the net sales figure. Okay, because and again, that basically, when we unaccrued it, it tied into what the cash that was received from customers was, meaning that we looked at the change in the accounts receivable to figure out what the cash sales were for this period. And then we unaccrued the dividend revenue, and we unaccrued the interest revenue accounts. Okay, those three accounts basically then were the basis for the sources of cash for this year. Okay, remember here, any gains or losses, okay, they are not going to be included on the statement of cash flows in the operating section. This gain on the sale of plant assets is going to be revisited when we look at the investing section. Okay, before the operating section, we don't worry about sales or purchases of plant assets because those are not in the continuing operations. Those are not included in the day-to-day operations of the business. Okay, so now we're looking at the uses of cash in the operating section. We looked at we unaccrued the cost of goods sold. Okay, and remember, how do we unaccrue these accounts? We look at the changes in the related balance sheet accounts. Okay, and now we're looking at, okay, how do we unaccrue the operating expenses? Okay, what else we have to unaccrue as a use of cash is the interest expense. Okay, we do not have to, again, in the operating section, we are not going to have to look at losses or gains on assets. We'll come back to that in the investing section. So here, loss on sale of marketable securities, we don't look at for the operating section. We don't consider it. So what else do we have to unaccrue? The interest expense and the income tax. Okay, so we have 3 more accounts that we have to unaccrue: the operating expenses, interest revenue, and income taxes. Okay, first thing I could tell you when you are unaccruing the operating expenses. See here how it says that it includes depreciation expense of $40,000. Okay, whenever you see that either depreciation expense is included in that, or if amortization or depletion, remember all of those are non-cash expenses. Since they are non-cash expenses, remember we have our visors on, we're thinking only cash for this financial statement. So when we see any non-cash expense being included in the operating expenses, we know immediately that that is the first thing that we have to deduct. Okay, so let's move ahead now to how we unaccrue our operating expenses. Okay, and when we're unaccruing operating expenses, we're going to have to look, again, it's through the balance sheet. We're still in operations. But we have to look here to unaccrue operating expenses. We're going to have to unaccrue any of the related prepayments. Okay, so were there any prepayments for operating expenses? And we can see here, yes, in fact, there is a prepaid expense account that appears on the balance sheet. Okay, and now what happens? Okay, what happened to the prepaid expenses? Okay, remember, prepaid expenses as they appear on the balance sheet are an asset. Okay, so what happened to the prepaid asset, the prepaid expense account? Did it increase or decrease from last year? Any suggestions? Did the prepaid expense account increase or decrease since the beginning of the year? Excellent, it increased. Very good. Joshua, Dante, Manpreet, excellent, and increased. So what does that mean? If prepaid expenses increased, okay, is that a source of cash or is that a use of cash? If an asset account increased, okay, is that a use of cash or a source of cash? It's going to be up. Denise, Kristen, think again. The asset account increase, it's a use of cash, okay? Because in order for the asset account to increase, the corporation had to use cash, okay, to increase that prepaid expenses, okay? And again, Denise, I know it's easy to say that, and Kristen, put on your cash hats. You're only thinking cash. You have blinders on. Okay, so here, if an asset increase, that means that is a use of cash. Okay, so we're going to add that $3,000 to our operating expenses. Okay, because in addition to the expenses, we also incurred another $3,000 of cash usage because of the fact that our related prepayment accounts increased. Okay, now in the beginning, remember, this financial statement seems like there's so much to remember. Just keep in mind, you always have to think cash, and that once you do the statement of cash flows, it's always the same situation. It's just repetitive. Okay, so it's just a matter of getting the hang of it. We're going through here a detailed one. We're going to have examples, of course, in our homework that we go over, and then we will have a quiz on it as well. Okay, so Denise and Kristen, I hope you see now how that's a use of cash. Okay, so now, again, we're working on the operating expenses. So we looked at the related prepayments. We know the prepayments increased, so it was an additional use of cash, okay, of $3,000. But just like the cost of goods sold, when we're unaccruing it, we have to look at another account. What are we looking at? We're looking at the other accrued expenses payable account. Okay, and now this is the tricky one. Stick with me. Okay, so here, remember, accounts payable is what type of account? Accounts payable is a liability account. Okay, now what do we see here? The liability account decreased, okay, from $9,000 to $3,000. Okay, and now again, when you're in doubt, all right, when you're dealing with the statement of cash flows, when you're unaccruing items, always go back to the journal entry. Okay, so in life, whenever you're in doubt, go back to the journal entry. So here, let's think about it. How is an account payable decreased? The only way an account payable is decreased is that you're going to debit that account. It has a credit balance. So other accrued expenses, okay, that account is going to be debited, okay, for the amount that we see decreasing here, which is $6,000. And then what account is going to be credited, okay, when other accrued expenses is debited? How do I pay off a payable? What do I have to use? I have to use cash. All right. So in addition, okay, in addition to using cash, okay, for the corporation used cash to increase their prepaid expenses account. In addition, the corporation used cash to pay off some of its liabilities this month. So this $6,000 was an additional use of cash for operating expenses. Okay? It was a use of cash because the corporation paid off some of its liabilities. So in addition, okay, to the amount that we see on the income statement, okay, appearing as the balance in the operating in the operating expenses. Remember, what did we do to figure out what the cash flow from operating expenses was? We subtracted out, okay? We took out the $40,000 in depreciation expense because that's not really a cash flow, right? So from the balance in the payables account, we unaccrued it by subtracting the $40,000 from the expenses because that was not a payment. In addition, we have to subtract the $3,000 use in cash from increasing the prepayments, okay? And we also have to subtract the $6,000, which was also a cash outflow for $6,000, okay? And again, it's always going to be those two accounts. All right, so let's look at the equation. Again, here, if we looked at some of our supporting information here, remember that here, during the short term, okay, and this is why the additional information section is so important. Look at number 4 here in the additional information. During the year, short-term prepayment expenses increased by $3,000. Okay, so that means that was a use of cash for $3,000, but also accrued expenses payable for other than interest or income taxes decreased by $6,000. Okay, so remember, only way accounts payable decreases is if you use cash. Only way short-term prepaid expenses, remember that's an asset account, only way that increases is by using cash of $3,000. And again here, depreciation for $40,000. Okay, remember that's a non-cash expense, so we have to take that off the top. All right, that is not a use or a source of cash. That's just a journal entry. Okay, everybody good? Okay, so now let's look at the equation. We put it into an equation format. And again, please still remember we're dealing only with the operating section still. And this, this chapter, it gives you a good walkthrough of the whole process. Okay, so now what happens here when we're dealing with accrued expenses? Okay, again, expenses we know can basically, the time that the expense appears on an income statement can be different from the time that the cash is paid with regard to that expense. Okay, we know that cash could be paid if it's a prepaid expense. We know the cash was paid in a previous time period. We know if we're merely accruing the expense in this period, we know that the cash can be paid maybe in a future period. Okay, again, the statement of cash flows, we're thinking only cash. Right, so this really tests your knowledge of accounting up to this point, okay? Because you have to rely on that. We learned all about accruing, okay? Expenses, accounts payable, revenue expense, balance sheet accounts as well. Now, for this particular financial statement, we have to unaccrue everything. So it's just a reversal of what we did. Use the journal entries, okay? Best way to solidify your knowledge. Okay, and again, remember, when we're converting accrual expenses, when we have any of these non-cash expenses, if these non-cash expenses are included in the operating expenses, the first thing we're going to do is always deduct them from the operating expenses because they don't involve cash. Okay. And again, here, what we're doing, we're looking at expenses, and we know that the time that the expense, the journal entry is prepared, cash payments could have appeared, the cash payments. If it's a prepaid asset account, we know that the prepaid asset account may have been paid in an earlier period. All right, that's why we unaccrue our expenses by looking at the prepaid assets. We know that the expense might have been paid in the current year, okay, and that's fine. We know we're going to deduct the cash related to that expense if it occurred during the current period, right? Because the expense and the cash flow from it are in the same period. That's no problem. However, if we have an accrual of cash, okay, or an accrual of an expense during the current period, okay, but the cash is not going to be paid until a future period, we know in that instance then we're going to have to unaccrue it. Okay, we're going to have to subtract any cash payment, okay, or add back any cash payment related to that expense because it's not paid this year. While the expense is recorded, the cash flow related to it is not happening until a future period. So that means it did not affect cash flow in the current period. Okay, questions? Okay, and again, once you do one of these, you become an expert. They're actually fun. It's actually a fun financial statement. Okay, because you kind of use all the information that you've learned so far. Okay. Again, if a payment is made in advance, you know you have the prepaid account, and you know prepaid asset accounts. If it was paid in a future period, it may not affect cash for the current period. Okay, because cash exchanged hands previously. If the payment is in the same period, okay, the expense is recorded during this time period, and the cash related to it was also paid. Okay, then you know, yes, this is included in the statement of cash flows for the current period. Okay, however, if payment is made in a later period, it does not affect cash in the current period, so you're not going to consider that amount. Okay, in the statement of cash flows, it must be reversed. Okay, so let's walk through this already. Okay, so we know, all right, so cash payments for expenses. We're looking at the operating expenses. We're unaccruing it on the income statement. Okay, that's always the starting point. When you're lost in the operating section, go back to the income statement. So here, these are the operating expenses. Now, on the income statement, all right, and what are we trying to do? We're trying to unaccrue the operating expenses, all right? How much cash was actually paid for these operating expenses? Okay, because again, this is always going to be a use of cash. Whenever we're on the expense side of the income statement, you know we're talking about uses of cash. Okay, so here we're starting with the operating expenses, and we're trying to figure out how much cash did we actually pay for these expenses. Always, especially in the beginning, just use this formula, okay, and eventually it will become second nature to you. Okay, so we start with the operating expenses, which we know if we look at the income statement equals $300,000. Okay, so how much cash did the corporation actually pay for operating expenses? We know right off the top, okay, when we have depreciation or any other non-cash expense, we're going to subtract that immediately, okay, because we know that didn't use cash. Okay, so since it didn't use cash, that $40,000 is going to be deducted, okay, from operating expenses because we know there was no cash involved in that. Okay, that's the first thing. That's the easiest thing. So now we've reduced our operating expenses, the payments for operating expenses for $260,000. Okay, but remember now we have to look at the change in the related prepayments, okay, which are the asset accounts on the balance sheet, and we have to look at the change in the related liability accounts as well. Okay, always what has to happen, always the formula. Okay, so when we look, okay, we're looking at the change in the prepayment accounts. Okay, so now remember the prepayments accounts, what type of account are they? You know, all the prepayment accounts are always asset accounts, right? They appear in the asset section of the balance sheet. So we look at the related prepayment account and we see, okay, if a prepayment account increases, okay, what's the journal entry if a prepayment, okay? Anyone? What's the journal entry when a prepaid asset account increases? Anybody have an idea? When a prepaid asset account increases, what's the journal entry? Not debit cash, debit the excellent Christian. You debit the prepayment. You are going to debit the prepaid asset account because it's an asset. It has a debit balance. And here in this instance, we debit the prepaid asset account for $3,000 because that was the amount of the increase. Okay. And then an excellent Jeffrey. And what do? How does that prepaid asset account increase? The corporation must use cash. Cash is going to be credited here. Okay, so now you could see whenever you are in doubt, go back to the journal entry. It will help you. Okay, so the way that this prepaid asset account increased, the journal entry must have been debit the asset account, credit cash. So right away, you know, is this increasing the prepaid asset account? Is that going to be a source of cash or a use of cash? Okay, when the corporation increases its prepaid asset account, is that a source of cash or a use of cash? Excellent, Mark. It's a use of cash. Very good. So that $3,000, what do you have to do? Since the prepaid asset account increased, that means that the amount of your payments increased by $3,000. You used in addition to the operating expenses for the current period, you also used cash of $3,000 to increase your prepaid asset account as well. Okay, so set up your worksheet this way. You add that $3,000 to your cash outflows. Okay, that's a use of cash. All right, now I'm going to, Joshua, so based on the formula, a plus related to prepayments means, yes, that's exactly right. A plus means that the related prepaid asset account increases, and a minus sign means it decreases. Okay, a minus sign here. Okay, means that it decreased, Joshua. All right. And same thing for the payables. Okay, so now to figure out how much cash was paid for operating expenses, we also have to look at the payables. Okay, so and the related payables account. And what are we going to do? If the related payables account decreased, okay, if a payable account decreased, what has to be the journal entry? If the payable account decreased, we know we're going to debit, excellent, Christian, perfect. We are going to debit the accrued liabilities payable. Excellent. Okay, we're going to debit the accrued liabilities payable by $6,000 because the liabilities decreased. Okay, and then what is the credit? As Christian said, the credit is going to then have to be cash for $6,000. Okay, remember, whenever you credit cash in the journal entry, that is always going to be a use of cash. Okay, so here, since the accrued liabilities decreased, okay, that means that the corporation used cash, okay, of an additional $6,000, okay, to pay off liabilities that it had outstanding at the beginning of the year. Okay, so Joshua, always look at each of these adjustments separately. Okay, so here you're looking at the asset account, the prepaid asset account. Increases in the prepaid asset account get added, okay, to get added in terms of uses of cash. If the related prepayment accounts decrease, what does that mean? Cash was not used during the current year to pay off a liability, what did they do? They basically reduced the amount of their prepayment. Okay, and the cash related to that prepayment, remember, was made in the previous period. Okay, then we're going to look, after we look at the prepaid asset accounts, then we're going to look at the related liability accounts. Okay, if the liability accounts decrease, that means that they paid off. In addition to the amount of expenses that they paid during the current year, they also paid off some of the liabilities that they had outstanding at the beginning of the year as well. Okay, what's the only journal entry when you pay off a liability? You must credit cash. So that $6,000 is going to be added, okay, to the operating expenses to get to arrive at what the actual cash flow from operating expenses was. Okay, and the formula is always the same. All right, so here, let's figure out how much cash did the corporation actually pay for operating expenses. Again, you start with operating expenses, that figure on the income statement. You subtract any non-cash expenses off the top immediately, the $40,000. Okay, then you look at the related changes in the prepayment accounts, the related changes in the liability accounts. You add those two figures. Okay, oh, you're welcome, Joshua. And ta-da, what do you finally get at? You get at the cash payments for operating expenses. Okay, and again, Joshua, put you on the spot. Is this $269,000 cash payments for operating expenses? Is this a use of cash or a source of cash on the statement of cash flows? The $269,000 payments for operating expenses, is that a use or a source of cash? Come on, Joshua. No, not source. Expenses are always uses. Very good, Mark, Kareem. Expenses are always a use of cash. Very good, Julie. Okay, so remember that. We're looking now, whenever we're looking and we're unaccruing the expenses section, those are always uses of cash. Just remember that way. Okay, so now we have, remember, we unaccrued our cost of goods sold earlier, right? We unaccrued our cost of goods sold. We know cash payments for merchandise, okay, was $495,000. That was a cash outflow, okay, because it was an expense. Now we have the operating expenses. The operating expenses, when they are unaccrued, equal $269,000. That is a cash outflow as well, or use of cash. So here, when we just put together our little schedule, here, when we have Allison Corporation, cash paid to suppliers and employees, okay, all we're doing is we're adding these two figures that we just unaccrued. The cash payments for merchandise, again, the source of that was unaccruing cost of goods sold. Okay, and then cash payments for operating expenses. Again, this is how much the cash outflow was with regard to operating expenses. Okay, these are both considered uses of cash. So we add the $495,000 plus the $269,000 of cash payments for operating expenses. Now we have a subtotal of a cash outflow, okay, or a use of cash of $764,000 on the statement of cash flows. Okay, always use the same formula. Okay, so that's just a subtotal that we're doing here. Everybody good? Okay, and ta-da, the last thing that we have to unaccrue is interest expense, income tax expense. Where in the world am I getting these from? Where am I getting these balances from? Just so you know where all this information is being generated. Okay, when in doubt, go back to the income statement for the period. Okay, again, you're going to unaccrue the income statement in the operating section based on changes in the balance sheet. Okay, so here, remember now, we just unaccrued this account, the operating expenses. What's left? We have to unaccrue interest expense, and we have to unaccrue the income tax expense. That's all that's left in the operating section. Okay, so we've walked our way through the income statement, and we walked our way through based on the changes in the balance sheet accounts. All right. So now let's look. What we know, we're dealing with interest, and we know that interest payable, and we know because it's a cash outflow, and we know that we're dealing with income taxes payable. So what happened in those related payable accounts? Okay, for interest payable and income taxes payable. See, isn't this becoming fun? All right, so we know here for interest, if we look at the interest payable, the liability, okay, remember, because we're looking at uses of cash. In the interest payable account, what happened? The interest payable account increased by $7,000. Okay, again, go back to the journal entry when in doubt. So how does the interest payable account increase? You know that you have to debit, you're going to debit the interest expense account, okay, for the $7,000. Okay, and then what's going to be credited here? If your payable account increases, what is going to be credited here? Is it cash or interest payable? Okay, if your payable account increases, Lysander, you think cash? Okay, pay at Christian, very good payable, very good Manpreet payable. So here, again, Shuling, excellent. So here, you know you did not pay cash. Why? Because the payable account increased. It gets credited further for an additional $7,000. Okay, again, remember, this does not involve cash. Okay, so what do you have to do with that increase in accounts payable? I'm sorry, in interest payable. This increase in interest payable is going to now be subtracted, okay, from the amount of cash paid. Okay, why? Because you know, for that $7,000, while you recorded the interest expense, that interest expense did not affect cash for the current period. Okay, it just increased because of the liability. So you know you have to adjust the cash payments made for interest payable when it increases. Okay, same thing, we're going to unaccrue now the income taxes payable account. Income taxes payable account, look what happened here. The income taxes payable account decreased, okay, from $10,000 to $8,000. All right, again, when in doubt, go back to the journal entry. What's the journal entry when a payable account decreases? Okay, what gets debited, guys, when a payable account decreases? You're going to debit cash for that difference of $2,000. Excellent. Okay, cash is going to be very good, Casey. Cash is not going to be debited. Cash decreases. It can't be debited. I was testing you. So what is going to be debited here? The income taxes payable. Income taxes payable is going to be debited for that decrease of $2,000. Okay, and why does an account payable decrease? Because of the fact that the corporation paid cash for it. So cash is going to be credited for $2,000. Okay, so income taxes payable debited, reducing the amount of income taxes payable. And then very good, guys, very good, Christian, Manpreet, Shuling, Casey, excellent. And then cash gets credited. Whenever cash is credited, what does that mean? That means it was a use of cash, okay, of an additional $2,000 when you're unaccruing those accounts. Okay, so isn't this fun, right? So let's look now. Is that true? Okay, so here, the last thing, when we're looking, okay, always rely also on the additional information section that will always help you in putting together the statement of cash flows. So look what happened here. They're telling us here basically that the accrued liability for interest payable increased by $7,000. Okay, so when the interest payable increased, we know the cash related to that expense, okay, was not paid. Okay, and if the accrued liability for income taxes payable decreased, okay, remember a payable decreasing means cash was used. It was a use of cash. Okay, so you see really how the journal entry, going back to the journal entry, really helps. Okay, so let's go back now. Let's use our equation again. Still in the operating section, still looking at the cash outflows. Okay, last things we have to do, exactly what we saw here, interest expense. Again, we got this information from the income statement. We're trying to determine how much cash did we actually pay for interest expense. Okay, the amount on the income statement is $35,000, but there was an increase in the liabilities. So that means that $7,000 of that expense was not actually paid this year. So what is the adjusted cash outflow? Okay, the cash paid for interest expense. Okay, because again, we're thinking only cash. We have blinders on for everything else. The cash paid for interest expense this year, okay, equals $28,000. Okay, when we unaccrue the interest expense. All right, now everybody's good with that? Any questions? Okay, now we're going to unaccrue the last account on the income statement for the operating section, which is income tax expense. Okay, again, when we incur income tax expense, every company and every individual, unfortunately, has to do that. When you make cash payments, okay, to the IRS, that reduces the amount of your liability. Okay, so if the liability decreased, that means cash payments were made to the IRS. Okay, because again, the corporation is reducing the amount of its liability. But if the liability increases, that means that the corporation did not pay cash for this expense during this year. Okay, so again, working our way down the income statement. Okay, we're looking at the income tax expense. $36,000, we got that from the income statement. We're going to look at the related balance sheet account, which is accrued income taxes payable. Okay, we're looking at the balance sheet account there. What happened to accrued income taxes payable? Accrued income taxes payable decreased. Okay, there was a decrease in the related liability account. We know the only way to reduce a liability account is by paying cash against it. Okay, so how much cash was actually paid for income taxes this year? $38,000. Okay, everybody's good? These are simpler, okay, when we just have simple accruals. For the expenses, we're just going to look at the related payables accounts. Okay, so ta-da, after this, look what we finally have. Now we have all of the cash flows from operating activities. Okay, again, remember this started, okay, with net sales. When we unaccrued the net sales figure, okay, we figured out that because we unaccrued the accounts receivable, we saw that the cash received from customers actually equaled $870,000. And these were cash inflows. Okay, remember, revenue accounts are always going to be cash inflows. Okay, what else did we look at? We unaccrued the interest receivable and dividends. Interest revenue and dividend revenue accounts. Okay, you can go back to the details. How much was the what was the cash inflows from dividends and interest, we know that the dividends and interest, the cash inflows equal $10,000. So what were the total sources of cash related to operations for this year? It equaled $880,000. Okay, remember that every time you basically prepare the statement of cash flows in the operating section, this is what you're going to have to do. Okay, the amounts may be different, but basically all the steps are going to be the same. Okay, so it's actually a little fun. Okay, now what's the next thing we look at? Cash paid to suppliers and employees. Okay, how do we rely, and again now, any expenses, remember that these are always going to be cash outflows. Okay, so these are always going to be uses of cash. All right, so here, remember the cash paid to suppliers and employees. Where did this information come from? We unaccrued cost of goods sold. We unaccrued cost of goods sold and the operating expenses. Okay, we unaccrued those two expense accounts to arrive at a cash outflow of $764,000. Okay, that was a big cash outflow. Then we unaccrued the interest expense by looking at, remember, the interest payable on the balance sheet. Always handled the same way. We unaccrue the interest payable. Then we, for the income taxes paid, we basically unaccrued the income taxes payable account. Okay, income taxes payable. Again, when we unaccrued it, we came up with a net cash outflow, okay, of $38,000. So in the operating section, cash inflows this year equaled $880,000. Cash outflows equaled $830,000. So what was the net change in cash due to operations? Okay, basically it was the operations provided $50,000 of a cash inflow for this particular year. Okay, and that is what we get from the statement of cash flow. Okay, very different. Okay, again, write the income statement and unaccrue the related accounts. And remember, any gains and losses on sorry about that. Okay, I'm back. All right, guys, so in the statement of cash flows, once we've completed the operating section, what is the next section that has to be prepared? Remembers OIF. So after operating, investing. Excellent, guys. Excellent, Lysander, Jason. So let's go to the additional information from the operating section. Okay, remember from the investing section, very important section. And these two sections are easier. Okay, so now, all right, when we're looking at the operating section, okay, which accounts are we typically going to be looking at in the investing section? Okay, where are we focusing our attention? Basically, we're going to look at the purchases and sales of marketable securities. Again, marketable securities means that these are investments in other companies, in the stocks and in the debt, the bonds payable of other companies. So we're going to look at the marketable securities accounts. We're also going to look at the notes receivable account, okay, on the balance sheet. And again, the notes receivable basically relate to loans that the corporation has made or have been repaid. Okay, so the notes receivable, the marketable securities accounts, the notes receivable. We're also going to look at the long-term asset accounts, the change in any of the long-term asset accounts. Okay, on the balance sheet, such as any changes in the machinery, equipment, building, land accounts. Okay, we're going to look at changes in the long-term asset accounts, and finally, any changes in the intangible asset accounts. Remember that chapter that we went over, I think chapter 9, intangible asset accounts. Okay, so for the investing section, okay, we are going to work our way down the balance sheet. And again, typically, if you look at the balance sheet is only going to provide you with what the ending balance in these accounts were. Okay, so typically you're going to have supporting information or additional information that is going to help you put together this financial statement. Okay, so let's look here. All right, the first thing that the additional information section tells us about the long-term asset, or about the short-term asset accounts, is that for the marketable securities account, okay, it shows debit entries of $65,000. So if marketable securities shows a debit entries of $65,000, meaning the marketable securities account increased over the year, if you had the journal entry by $65,000, is that going to be a source of cash or a use of cash to the corporation? Again, think cash only. If the marketable securities account increases by $65,000, is that excellent, Christian? That is going to be a use of cash. The only way the corporation could have gotten more marketable securities is if they purchased it, and that requires cash. Okay, but now, okay, this is where the asset accounts get a little bit tricky. Okay, so now you have the marketable securities account, and the marketable securities account shows a credit balance, or shows a credit entry, okay, on its general journal, general ledger. And again, you wouldn't see this normally. You're just looking at the balance sheet accounts. Okay, but here in the additional information section, you're getting the additional, the background for what happens in all of these accounts. So if the marketable securities account decreased or is credited for $44,000, what does that mean? That means that the corporation sold marketable securities. Okay, the corporation sold marketable securities which had a book value. Okay, remember the book value is the amount that is credited. So this $44,000 means that securities basically for an amount of $44,000 were sold during the course of this year. Okay, now that gets a little tricky. Okay, so everybody has this, the types of transactions, very important. The types of transactions that are reported in the investing section, the purchases and sales of marketable securities, notes receivable, long-term assets, and intangible assets. Okay, now though, I'm going to bring you back to the income statement. So this information is going to be eliminated, okay? And I'm going to bring you back to the income statement because we have to figure out what was the actual cash inflow from this $44,000 sale of marketable securities. Okay. So now, remember that information we ignored in the operating section? Now we're going to look at it. Okay, so here, look what happened here. Loss on sale of marketable securities, $4,000. Okay, so that means that when these marketable securities were sold, they were sold for $4,000 less than what they were paid for. Okay, so we know what we just saw, okay, is that when the book value of those securities was credited, we know the purchase price of the securities equaled $44,000. Okay, but since the corporation had a loss on the sale, okay, loss on the sale of marketable securities of $4,000, what does that mean? That means how much cash did the corporation receive when they sold these? Very good, Joshua, $40,000. Okay, so the cash inflow, okay, from these marketable securities was not $44,000. The cash inflow was only $40,000. Okay, so now we have to consider all of the losses and gains, okay, that appear on the income statement because we didn't think about them before. Okay, so the cash inflow from selling marketable securities was $40,000. Okay, just as a precursor, just as a reminder, we know, remember I said that any gains or sales on plant assets, okay, they are considered in the investing section also. Okay, when we go to the next step, okay, see that gain on the sale of plant assets, okay, we are going to revisit that in a minute. Okay, so where did the $44,000 come from? From the additional information section. Okay, the additional information section told us that the credit to the marketable securities account equaled $44,000. So you have to go back to your 101 accounting information. Remember that when an asset account is credited, okay, that asset account is always credited for the cost of the asset, which was $44,000. But here, since they're indicating there was a loss, okay, on that sale, that means that the cash inflow, okay, nope, the cash inflow was only, the cash inflow was only $40,000. Okay, and no, remember that when we're looking, we've left the operating section, so we're not going to look at the income statement anymore. But if we looked at the marketable securities section, okay, we see that the marketable securities account changed for $21,000. There was a change in the marketable securities account for $21,000. Okay, and what was that change? That change was an increase in the account. Okay, but now where did that increase in $21,000? What were the details behind the change of $21,000? Again, we're going to look at the additional information section in the investing activities. And we see that if we looked at the general ledger, we see that the purchases equals of additional marketable securities equals $65,000, and the sale of marketable securities equals $44,000. Okay, but remember the cash inflow was only $40,000. Okay, so when we unaccrue the marketable securities account, okay, what are we going to generate? We're going to see that the amount of cash received, okay, from the marketable securities account is basically going to equal the is going to be $25,000. Okay, the actual change in cash from the marketable securities section. Okay, now what else do we have to look at? Another account that we have to analyze is the notes receivable account. All right, again, the notes receivable account, we have to know the detail behind those changes. So here we're told that notes receivable, and again, notes receivable always represent loans. Okay, and these again are loans that the corporation basically made to outside parties, or loans that that were paid back to the corporation. Okay, so here, if we looked at the general ledger, we would see that the notes receivable were debited by $17,000. Okay, that means that $17,000 basically was lent. Okay, was loaned by Allison Corporation to the borrowers. Okay, and we also see that a notes receivable was credited for $12,000. Remember, how are notes receivable credited? Why? Because basically that means that the loan was paid back. Loans of $12,000 were paid back. Okay, so again, that's a debit to cash of $12,000 and a credit to notes receivable. Okay, of $12,000. Okay, so always go back to the journal entry. All right, so now we see the cash flows with regard to the notes receivable. Okay, and again, finally, if we look, okay, and this is an important thing, and it's kind of cut off here, I'm sorry about that. If we looked at the plant asset accounts, okay, we'll see that the plant asset accounts increased by $116,000. Okay, so how does the plant asset account, well, how does it increase? We know that we're going to basically debit the plant asset account. Okay, and then what do we have to credit? We're going to credit cash for the related cash that was paid for that plant asset. But what we're going to see in a moment is that the full amount of the purchase, okay, was not paid for in cash. There was also a note payable that was taken out. Okay, there was a note payable that was taken out for $60,000. All right, so let's think about this. All right, now we have the journal asset of the journal entry. All right, plant assets increased by $116,000. Okay, so let's think about this. Let's go to the investing section. Okay, and let's look at the changes in cash based on investment. Okay, remember, okay, a lot of information, we're now on the second section, in the investing section. A lot of information about the investing section is taken just by looking at the related accounts on the balance sheet. Okay, if you have a debit in these accounts, okay, in any of the plant asset accounts, again, what does that mean happened? Okay, always go back to the journal entry, your basics. When an asset account is increased, okay, you know that typically it is going to be debited, okay, and again, which accounts are credited? The cash account, meaning cash used, but there also could be a note payable. That's why you really need the additional information section, okay, for the investments. All right, so this is a journal entry typically when the asset accounts increased. Okay, however, you could also see credit entries in the asset accounts. When the asset accounts basically decrease over the course of the year, what does that mean? That means that assets were sold. Okay, when assets are sold, what is the possible journal entry? Okay, what is the debit to? What is one of the debit accounts that could be affected? Okay, when an asset is sold. When an asset is sold, typically what happens? The asset cash is going to be debited, right? When an asset is sold, typically cash is going to be debited. And then what happens to the related asset account? The related asset account is going to be credited. Okay, but remember, okay, when an asset is sold, you're always going to credit what the book value was. Okay, so you have to pay particular attention to the additional information section, okay, when you're trying to figure out what the cash proceeds were with regard to the sale of an asset. Okay, so here it's easier, I think, to explain it just from the schedule. All right, so let's look at the first account. Okay, let's look again at the changes in the marketable securities account. All right, here we're told that marketable securities were debited for $65,000, meaning that there were purchases of marketable securities of $65,000. Okay, again, remember you have your cash blinders on. Okay, when the corporation purchases marketable securities, remember that is going to be a use of cash, right? Purchases of marketable securities are a use of cash, all right, for $65,000. Okay, when a corporation sells marketable securities, okay, that's a credit to the marketable security account. But again, look what happens here. Remember, the marketable securities, the original cost was $44,000. Okay, but on the income statement, we know we saw a $4,000 loss on the marketable securities sale. Okay, so what was the cash inflow? Okay, what was the net cash inflow, guys, from the sale of marketable securities? Okay, we start out with 44,000 because that's the book value. Okay, but what was the net cash inflow, guys? Anybody with me? Okay, book value was $44,000. Remember, there was a loss. Okay, so excellent, Manpreet, Dante, excellent. Okay, since there was a loss on the sale of marketable securities, Casey, excellent. What was the cash inflow on the marketable securities? The cash inflow equaled $40,000. Very good, Lamai. Okay, and that's what we see here. And remember, that is going to be a source. Whenever an asset is sold, it's always going to be a source of cash. Okay, and here it's just the source of cash, wasn't the full $44,000, which was the book value. It was less the $4,000 loss. So what was the cash inflow? Only $40,000. So what you're going to do in the investing section, just look at all the asset accounts, and you're going to itemize the changes in the asset accounts. Okay, so in the investing section, you are simply going to itemize or detail the changes in the related asset accounts. Okay, And remember, though, that when you look at the asset accounts, you're looking at the changes in those asset accounts, but you only have the balances there. So you're going to have to rely on the additional information section heavily, okay? For the, you're going to have to rely on the additional information section for the investing section and for the financing section as well. Okay, so the first asset account we looked at was marketable securities. We looked at the changes in marketable securities, and we see here for purchases of marketable securities, $65,000. Excuse me, that was a use of cash of $65,000. We sold marketable securities. The gross or the net proceeds on the sale of those marketable securities equaled $40,000. Okay, now we've itemized the changes in the marketable securities account. Okay, let's look at the next asset account, okay, that changed. Okay, we also know, we also know that the notes receivable changed, when I mean itemized, I mean detail. Okay, what was the detail behind the changes in the marketable securities account? Okay, so here now, Joshua, let's look at this. All right, what were the details behind the changes in the notes receivable? Okay, what were the details behind the changes, you're welcome, in the notes receivable account? Again, you really needed the additional information section. Okay, so here the additional information section told us, okay, that the debit entries in the notes receivable equaled $17,000. Okay, so that, what does that mean? That means that new loans, okay, were basically given by the corporation. Remember, when notes receivable increase, what is the related journal entry? Okay, when notes receivable increase, okay, what is that journal entry? Remember, notes receivable are an asset account. So when we increase notes receivable, okay, we're debiting the notes receivable for $17,000. Okay, very good. And what gets credited when the notes receivable get debited? What is the related, what is getting decreased? Okay, excellent, Kristen. Okay, cash is being paid. Excellent. So cash is being paid of $17,000. That is a use of cash of $17,000. Excellent, Maya. Okay, so that is a use of cash that we see here for the $17,000 because the corporation is loaning out $17,000 more dollars. But we're also told that the corporation also collected on some of its notes receivable. When the corporation collects on its loans, collects on its notes receivable, again, best way to figure this out, go back to the journal entry. So when a corporation collects on notes receivable, it debits cash for $12,000. And again, what gets credited? Notes receivable gets credited for $12,000. Okay. So what does that mean? That means based on the change in the asset account of notes receivable, okay, we know that the corporation issued new loans, okay, of $17,000. We know that is a use of cash for $17,000. Okay, we know the corporation also collected on some of its loans. Their debtors basically paid $12,000 worth of cash. So, sorry, that is going to be, when you have a collection on a loan, that's going to be a source of cash. Okay, so here all we're doing is detailing what the changes in the notes receivable were. So the detail behind the changes of the notes receivable is there was $17,000. It was a $17,000 use of cash and a $12,000 source of cash, okay, for the notes receivable. So what was the change? And again, how do I know this? That means that the change in the notes receivable, if I look at the balance sheet, what should the change in the notes receivable be? Okay. If I look at the change in the notes receivable balance sheet, based on this information, what should the change in the notes receivable account be? $5,000 what? Which direction? Use or source of cash? $5,000 use of cash. Very good. Okay, so there's a use of cash of $5,000. Excellent, guys. Okay, in the investing section for the notes receivable, and this is just the detail behind it. Okay, this is just the detail behind the change in cash. All right, so now we've dealt with the change in the next asset account, which is notes receivable. Okay, don't worry about that. What's the next change in the asset account? Okay, so the next change in the asset account, again, in the additional information section. Okay, what happened to plant assets? Plant assets increased by $200,000. Okay, but look what happens here. Only they paid $160,000 in cash. So that $160,000 is a cash outflow. Okay, with regard to this asset. Okay, but what else happened? The corporation also issued a long-term note payable of $40,000. Does that $40,000 represent a cash inflow or outflow? Okay, does that $40,000 long-term note payable change any cash inflow or outflow? Okay, again, let's go back to the journal entry. Okay, if a corporation purchased plant assets, okay, for $200,000, we know that the plant asset account is going to increase by $200,000. That's what it's going to be debited for. Okay, what was the journal entry to pay for that? Pay for that plant asset. You know, cash was credited or cash was used for $160,000. Okay, but okay, remember that cash decreased by $160,000, but there was also a long-term note payable. Long-term note payable was also credited for $40,000. Okay, so this was the journal entry when this asset was purchased. Okay, what now? What is required? Okay, so everybody hold on. What is required, okay, when there is a significant change in assets, okay, when there is a change in the assets, okay, that is basically substantial, okay, and it does not involve cash. Okay, so here we see that $40,000, okay, $40,000 of the purchase price of that plant, property, and equipment was a change in assets, but it did not involve cash, right? Okay, what is required? Okay, what is required in the statement of cash flows? That there is a requirement that you have this supplemental schedule, okay, which details what the changes in the asset account were, okay, that did not involve cash. Okay, so the corporation, if in this instance, if let's say an example, if the corporation purchased a long-term asset, but they didn't pay for cash, they issued stock in it for payment. All right, again, that's a significant non-cash activity. Okay, same thing here. Since the corporation purchased the plant asset, which was worth $200,000, okay, but since a portion of it was financed through long-term debt, as it was not financed through cash, okay, it is required that this type of transaction, a significant non-cash transaction. Okay, so here, any significant non-cash transaction any significant non-cash transaction has to be recorded in a section that is called the supplemental schedule of non-cash investing activities. So after you have the whole statement of cash flows, you're now going to have the supplemental schedule as well. Okay, and all the supplemental schedule does is basically detail how any of the asset accounts changed, but it did not affect cash. And now why? Who cares? Why is this additional information being reported to the on the statement of cash flows to the investors and the creditors? Because of the fact that it is important. Okay, if the corporation buys an asset and it doesn't use cash to buy or sell that asset, GAAP requires that that information be detailed in the supplemental section. So haven't even thought of the midterm, but this will be a 3-point question on the midterm. What happens if the corporation has a significant non-cash event? Okay, that significant non-cash event is going to be itemized or detailed. That significant non-cash event is going to be detailed in the supplemental schedule. So this is just an additional schedule that has to accompany the statement of cash flows. Okay, whenever there is a significant non-cash event that occurs. Here, again, since $40,000 of this purchase was financed through the issuance of long-term debt, that information has to be included in that supplemental schedule. Okay, so everybody good? Questions? Okay, so again, in a nutshell, any significant non-cash transaction of the corporation, okay, has to be detailed in the supplemental schedule. So you have the statement of cash flows and this supplemental schedule as part of the statement of cash flows. Okay, everybody good? And again, we're going to go over this a lot in the homeworks. Okay, now, okay, so that was purchase of plant assets. Okay, and again, we're just working our way down the additional information section. And you're like, oh my God, oh my goodness, where in the world is she getting this information from? Again, when you do the investing section and the financing section, you're going to rely heavily on the additional information. Okay. And this is the additional, and here the additional information section from investments. Here, so you know where I'm coming from. If you're lost, again, all we're doing is basically going through the journal entries and looking at the cash flow, cash inflows, and the cash outflows related to the investing activities. And again, here, this is where we're working from. Okay, always go back to the additional information. So what we're doing here, we walk through the changes in cash from the changes in the marketable securities account, the changes in cash due to the changes in the notes receivable, and now we're looking at the changes in the plant asset accounts. Okay, so typically you're going to be looking at the additional information section. And that's all we're doing here. And then we'll look at the financing section next. All right, so again, let's just look at the investing section, the investing section, the second section. Okay, what were the cash flows from the changes in the asset accounts? All right, stick with me. All right, so now again, the first change in cash flows from the investing accounts was the purchase and sale of marketable securities. So here we have the cash flows from the changes in marketable securities. Now we have the cash flows related to the changes in notes receivable. Okay, we just walked through that. Now we also talked about the changes, the supplemental schedule. Okay, which itemizes the cash flows from of the purchase of plant assets. So we know that what was the cash outflow? Okay, so if I asked you here, what was the cash outflow related to the purchase of assets? What would you say? The cash outflow with regard to the purchase of assets? Anyone? Excellent, Daniel. Bring it home. 160,000. Excellent, Daniel. Okay, so the cash outflow with regard to the changes in long-term assets was 160,000. All right, now we have to look at the cash inflows from the related from the sale of plant assets. Okay, so here an analysis of the plant assets account shows that plant assets changed by $44,000. Okay, so now what happened? Okay, basically we know that the corporation sold plant assets for a total of $44,000. That's what we see here. The plant asset accounts was credited for $44,000. Okay, but remember on the income statement. Okay, remember that when we were looking at the income statement, we also saw there was a gain of the sale of plant assets. All right, so let's think, okay, what is the journal entry when a corporation sells plant assets? We know there's going to be a debit to the cash account, okay, and we know that the proceeds from the sale was $75,000. Okay, and again, we were told that the proceeds from the sale was $75,000. Cash is debited of $75,000. Now, let's look at the plant asset. The plant asset account, what was the book value of the plant assets that were sold this year? We see that the book value was $44,000. Okay, but wait a minute. Our debits don't equal our credits. Okay, so what was the additional credit to when we sold this plant asset? What was the additional credit to? We received cash, $75,000. Plant asset gets credited for $44,000. Okay, what is that additional? What's the difference between those two accounts? Again, our debits and our credits have to equal. All right, so what is the credit to in this journal entry when we sell our plant assets at a gain? We know we are going to credit gain on sale of plant assets. We are going to have to credit that account for how much? For the difference between those two amounts, which equals $31,000. And again, you're told this information. You just have to figure out, what does this information mean? Okay, so we know we sold a plant asset. The plant asset had a value, a book value of $44,000. Okay, we know though that we sold it for $75,000. All right, so again, what was the source of cash? Okay, what was the source of cash with regard to the sale of that plant asset? Again, think only cash. You have blinders on for cash. How much cash did you receive? $75,000. Good, very good, Manpreet, the $31,000 gain. But what was the total source of cash? The source of cash equals $75,000. Okay, very good, Joshua. All right, so let's bring this home now. Okay, what were the total changes? Okay, and again, this is now the second section. Okay, this is the section, the cash flows from investing activities. Okay, so the cash flows from investing activities, we know we had a cash outflow. I'll just put O here. All right, that was an outflow of $65,000 when we purchased securities. Again, thinking cash only. Okay, and when we sold marketable securities, what was that? Remember, it was a source of cash for $40,000. Okay. Now, when the corporation made loans to the borrowers, again, and where do we get this from? From the notes receivable. When the corporation made loans to the borrowers, that means there was an outflow of cash, okay, of $17,000. Okay. Again, when a corporation, thinking cash only, when the corporation collects on outstanding loans, what was that? That was a source of cash for $12,000. Okay. Then finally, the last asset account that was affected was the plant assets. Okay, so we looked at the asset accounts of plant assets, notes receivable, marketable securities first, then notes receivable, and then finally plant assets. Okay. What was the cash outflow from the purchases of plant assets? Remember, the corporation paid $160,000 cash for new plant assets. Okay, again, only cash here. We don't care that the value was $200,000. What were the proceeds from the sale of plant assets? Again, we had a gain in there. So this, again, $160,000 was an outflow of cash, the purchase of plant assets, and the proceeds from the sales, that was a source of cash, an inflow. Okay, so again, all these sources of cash with regard to these three plant asset accounts, those are all cash inflows. Okay, and again, whenever new assets were purchased, those were always cash outflows. So what was the net change in cash? Okay, with regard to the investing section, what was the net change in cash? The net change in cash for this year for the investing section was negative $115,000. Okay, all right. And again, remember, we relied on a lot of this information. We had to look at the additional information section on the additional information section that is provided. All right. All right. Now you can see it's tricky. This is a very different financial statement. Okay. We're going through the details. We're walking through each of the changes. Again, in cash. Okay. That results from the changes in marketable securities, notes receivable, and the plant asset accounts. Taking a walk through the balance sheet to figure out what the changes in cash were with regard to these asset accounts. Okay, so now we've completed our second section. We've completed the investing section. Okay, we see that total cash outflows equaled $115,000 for this year. Okay, again, why do we go through this? Why is the statement of cash flows such an important financial statement? Again, because this is the only financial statement that deals with cash. Okay, we're thinking only when you're preparing this statement, all you're thinking of is the changes in cash. Okay, and you're going to think of cash inflows and cash outflows. Okay, it's the only financial statement that deals with these two issues. And again, what do you have to do? You have to unaccrue all of these changes in the asset accounts. All right, so now we've completed the operating section, okay, and now we've completed the investing section. All right, let me just introduce you to the financing section. And the financing section, OIF The financing section is the last section, okay, that's going to be completed. The financing section is easier, okay, because the financing section only deals, okay, with changes in bonds payable, notes payable, common stock, and dividends. Okay, so when you're dealing with, we're now going to look at the financing section. Okay, in the financing section, what are you going to look at? The financing section looks at changes in the following accounts. Again, usually it has to be detailed in the additional information section. So you're going to look at changes in the bonds payable account, okay, in the notes payable account, okay, in the common stock, account, and additional paid-in capital, because remember those two are always related, and additional paid-in capital. Okay, and then finally, the last account you go to is the dividends. Okay, so when we are preparing the financing section, basically, what are we looking at? We're looking at the changes in each of these respective balance sheet accounts. Okay, remember how when we were doing the investing section, we looked at the asset accounts. Here, we're looking at debt and equity, the changes in the debt and the equity accounts. All right, so at this point, let's finish up here. Okay, we will meet again on Thursday. Remember, we're having a quiz on this chapter on November 10th. Start the exercises, the homeworks for this chapter. The next exam, I'm not sure yet. As we get closer to the date, I'll know a little bit better. Okay, so November 10th is the quiz, and it's only on chapter 13. And we'll continue with this slide and finish with the statement of changes, statement of cash flows when we meet next time. Okay, so everybody vote early if you can. Wash your hands. Remember the rates are going up. You're welcome, Manpreet. And see you next time. Everybody remember, wash your hands, stay healthy, stay happy. And you too, everyone. Have a good day. All right, and need your accounting. You're welcome, Gerson, Denise. Thank you. Thank you for attending. Work hard, okay?